This is Matt Restuccia, the Chief Investment Officer at Argent Wealth Management, and this is the November to December 2024 Market View. At Argent, our differentiation is our deep knowledge and practice of tax, estate planning, and investments under one roof. You can connect with us on various social media sites, LinkedIn, Instagram, Facebook, X, and YouTube. The conclusion for this market view is that the bull market is likely to continue well into 2025. Recession odds remain low, and inflation continues to dissipate. The Fed is in an easing cycle, which is historically positive for equities, and the current bull market remains shorter than the average bull market through history, implying that there is more room for this bull market to go before it ends. So let's look at some economic indicators. Credit conditions, which is very important to the US economy. And we can see here that the availability of credit to consumers and businesses is favorable. Credit is available to expand your business or buy a home. And as you can see historically, this measure tends to trend downward if a recession is imminent, which is the light gray shaded areas, and usually goes negative right before a recession. We are not only far away from 50, we're at 70, but credit conditions are improving and continue to improve, so a recession remains unlikely. Unemployment. There still are 1 times the number of job openings per unemployed, well above the average historically going back to 2000. So the job market remains strong. And we can see here credit card delinquency rates, which tend to be a pretty good indicator of if the US consumer is starting to overextend themselves. Usually the credit cards are a place where you start to see early indications the consumer is weakening, with 70% plus of US gross domestic product, GDP, from consumers. This is important to watch, and we can see that delinquency rates still remain well below history. And that's another positive economic indicator and another positive sign that a recession is unlikely in the next year, at least for the next year. And we can see inflation is coming down. CPI is on a downward trajectory. Headline CPI is now 2.41%, which is close to the Fed's 2% target. Core CPI is also coming down. It's just over 3%. And at the same time, real GDP, the growth of the economy net of inflation, is at 2.8%. And that's about average through history for the US. It's pretty solid. So you have economic growth, which is steady, and inflation coming down. What's not to like about that? And the Federal Reserve has ammunition. The federal funds rate is at 4.75 to 5%. That leaves the Federal Reserve with plenty of room to decrease rates to support the economy if it falters, which looks unlikely. So even if the economy started to change course, the Fed has plenty of room to reduce rates to fight off any deflation or any potential economic downturn. Now, investors are pricing the likelihood of 2 rate cuts before year end and another 3 to 4 by June 2025. So it's going to be a slower easing cycle, and that tends to support equity markets for a longer period of time. And you can see the stock market, the Dow Jones Industrial Average here, goes up on average over 20% in the first year after the first rate cut, when there is no recession, which we are predicting. Even when there is a recession, the market is positive 1 year later after the first rate cut. And we can see seasonality is on our side too. The first year of a presidential cycle, the first year that the president, after the president's been elected, tends to be positive for stock markets. This is based on data from 1964 through 2003. And that's the case even if fiscal and monetary policy index is becoming more restrictive. Well, the Fed is in an easing cycle, so it's likely that the monetary and fiscal policy index is going to remain accommodative. So things are lining up well from a seasonality or a cyclical basis. And we look at the history of cyclical or the short-term bull markets within long-term bull markets or secular bull markets, which is what we are in today, both a cyclical bull and a secular bull. And they've averaged 751 days with their turns over 100%. Where are we today? The current short-term or cyclical bull market has lasted about 530 days so far and is up around 55%. So still well within reason to see equity markets continue to advance, at least for the next year and maybe even beyond. And if you look at the history of secular or long-term bull markets, and we've been in this one since 2009, and you look at the previous two were 1982 to 2000, where the stock market was up 16.8%, the Dow Jones on average a year. And you look at 1942 to 1966, and that was 10.5% per year, the Dow Jones. The last bull market, the one from 82 to 2000, was 18 years, and the one before that was 24 years. So we're about 15 years in, and that's shorter than the last two, and returns have been 12.6% per annum. So right kind of in the middle between the last two. So again, would not be surprising to see this long-term bull market last at least another few years and maybe more than that. Thank you for listening. Again, this is Matt Rastusha, the Chief Investment Officer at Argent Wealth Management.